All right, let's talk about one of the most common and maybe one of the most misunderstood tools in all of investing. I'm talking about the price-to-earnings ratio, or the PE ratio.
So let's just dive right in with a question that, honestly, trips up a ton of investors, not just new ones.
I mean, your gut probably tells you, yeah, of course the $100 stock is more expensive. But, and this is a huge but, the share price all by itself, it tells you almost nothing about whether a stock is actually a bargain or not. It's a total illusion.
So to get to the real answer, the tool we need is the PE ratio. And to understand what that is, let's just forget about the stock market for a second. Let's use a really simple, real-world example instead. Okay, so imagine you're thinking about buying a local coffee shop. Trust me, this is going to make the whole PE thing click.
First thing you look at is the price, right? What's it going to cost you to buy the entire business, lock, stock, and barrel? Let's just say it's an even $100,000.
Okay, but the price is only half the story. The next question is, how much money does the shop actually make? And I mean real profit. You know, the cash left in your pocket after you've paid for the coffee beans, the rent, the employees, all of it. Let's say this little shop makes a nice steady $10,000 a year in profit.
So, the math here is super simple. You just take the price you paid, that $100,000, and you divide it by the profit, or the earnings that it makes every year, that $10,000. What does that give you?
It gives you 10 years. That's how long it would take for the coffee shop's profits to completely pay you back for your initial investment. And that, my friends, is exactly what the PE ratio is. It's just a fancy term for the payback period. That 10, that's a PE of 10.
So now let's bring that idea back to the stock market. The formula is literally the exact same thing. You take the price of one share of stock and divide it by the earnings per share, or EPS. It's the same payback period logic, just scaled down to a single share of the company.
Okay, so a lower number means a shorter payback period. That sounds great, right? So a lower PE must always be better? Well, this is exactly where things get tricky, and it's where a lot of investors really get into trouble. See, a low PE, say like 5, could mean you found an amazing, undervalued company. Or it could be what we call a value trap, a company that looks cheap because its business is actually falling apart. On the flip side, a really high PE, like 100, might mean a company is dangerously overvalued. Or it could be an incredible, fast-growing company that everyone expects to take over the world. See the problem? The PE isn't telling you if something is good or bad. It's telling you what the market expects to happen.
Yeah, there's a saying for this. A low PE isn't always a bargain. Sometimes you're just catching a falling knife. You think you're grabbing a deal, but you're really just buying into a dying business. And look, that's bad enough. But the real fireworks, the real danger, happens when one of those high PE stocks, one with all those sky-high expectations baked in, suddenly stumbles.
And this brings us to a really dangerous phenomenon, a concept that the legendary investor Shelby Davis gave a pretty intense name, the Davis double killing.
Let's go back to our shop example. But this time, imagine it's a super hyped-up bubble tea shop. I mean, it is the place to be. The lines are around the block, the company is earning $2 per share, and because it's so trendy, Wall Street is just totally euphoric. Investors are willing to pay 30 times its earnings, a PE of 30. So $2 in earnings times that 30 PE gives you a $60 stock price. Everybody's happy.
But then, a little bit of trouble shows up. A new competitor opens up right next door. And you know what? Their tea is actually pretty good. The lines at our shop start to get just a little bit shorter.
Okay, now watch what happens. This is where the carnage begins. First, the earnings take a hit. They drop from $2 a share down to $1.50. That's a 25% drop. That's bad, for sure. But here comes the second punch, and this is the one that's the real killer. Investor sentiment. That euphoria, it completely collapses. The hot stock story is over. So the market just hacks the PE multiple in half, from that crazy 30 down to a much more normal 15. You got hit once on the earnings, and then a second brutal time on the valuation.
So you do the new math. $1.50 in earnings times a PE of 15 gives you a new stock price of $22.50. The stock has crashed 62.5%. A pretty small 25% dip in profits caused a catastrophic stock market crash. That is the Davis double killing. You get punished for the earnings drop, and you get punished for the collapse in expectations.
So knowing all this,
how do you actually use the PE ratio the right way and, avoid getting caught in a trap like that?
Okay, here are the big things to remember. First, just be really careful with stocks that have super high PE ratios. It basically means the market is expecting absolute perfection, and there's just no room for any mistakes. Second, you should always run a little what-if scenario in your head. Ask yourself, what would this stock be worth if the PE just went back to normal, like the industry average? The potential downside might really surprise you. And finally, and this is maybe the most important part, remember that the PE ratio is just one tool in your toolbox. You have to look at the bigger picture, the quality of the management, the business itself. It's never about just one number.
And that really leaves us with this one last crucial thought. The PE ratio is great at telling you the price you have to pay. It's a window into the market's current expectations. But real, long-term investing isn't about paying for expectations. It's about digging much deeper to figure out the real, lasting value that you're actually getting for your money.